Welcome to the IRE.IQ Quarterly Fundraising Report Review. Thank you for joining us for a look at closed-end real estate fundraising activity as tracked by our IRE.IQ database. We will be sharing some trends and data covered by our Q3 2025 IRE.IQ Fundraising Report, which was published Thursday, November 5th. Today, I'll be joined by a pair of industry experts to discuss the broader trends affecting real estate fundraising, where the market might be headed. For those of you who have joined one of these before, I will share a brief slide presentation with data and charts from the IRE.IQ fundraising report, and then me and my panelists will have a broader conversation about fundraising. We will also be answering questions from the audience through the Q&A feature, which you can access at the bottom of the screen. As I remind you every time, all the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts, and it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now, and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package. If you are not a sponsor and interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. I'd now like to welcome our panelists, if they could join me, Lauren Sertich of Callan and Brian Kinsella of CrossHarbor. Hello, Brian
Loretta.
and Lauren. Thanks for joining us. I think we're going to go ahead and start with each of you giving just sort of a brief overview of your role and where you sit in the fundraising ecosystem and what perspective that gives you on the market. So I'm going to go ahead and start with you, Brian.
Sure. And thanks for having me, Loretta. So I am Brian Kinsella. I'm a senior director with CrossHarbor Capital. My focus is primarily on business development. We have a number of different strategies, institutional funds across both equity and debt. And so from a perspective standpoint, I'll be bringing kind of the thoughts of talking with a lot of other LPs that are currently investors of ours or potential investors of ours. I will say I also spent about 7 years before joining CrossHarbor with CBRE Investment Management. So I have some perspective from that part of the business as well, including open-end funds as well as other real asset type of strategies. So look forward to the conversation today.
And Lauren.
Hi, I'm Lauren Sertich. I'm a senior vice president in Callan's Real Assets Consulting Group. As part of my role, I serve a dual function. So I'm working directly with a number of our clients. So I'm seeing their whole portfolios, helping them allocate across the risk spectrum. But also I serve a research function within our group and I cover the non-core real estate universe. So a lot of the funds that are included in this report are under sort of my research purview. So I've done a deep dive into that space, but again, I help our clients allocate across the risk spectrum.
Excellent. So you did mention what we have in the report. So I'm going to go ahead and begin sharing a presentation, which has, just like I said, a few slides. And this will be an opportunity just to sort of share with our audience. These are things that we have seen. If you've already read the report, you'll have seen a lot of this, but this may also be new for some of you. So this is, as I said, this is Q3 data. So it's important to understand that we're looking at closed-end funds investing in direct properties, equity, or real estate debt. This current report, we're sharing data on funds with a final close between July 1st, 2025 and September 30th. And again, another thing that I always say, this is a snapshot in time. It's possible additional funds have closed but haven't announced yet. You know, our IRE.IQ team, they're learning about fund closings continuously as the year go by. We're updating the data accordingly, but this sort of shows what things were as of the time when we posted the report, which, like I said, was last Thursday. And a final comment to the audience, just as a reminder, we are taking questions using the Q&A feature. I will pose the broader questions to the panelists, but anything that's maybe more of a technical nature about the details in the report, my IRE.IQ colleagues are here to answer those questions as well. So let's let's get into it. $20 billion was raised by 26 funds, holding a final close in the third quarter. This follows $24.5 billion by 28 funds in Q2 and $51 billion raised by 30 funds that held a final close in the first quarter. Year to date, we have already seen more funds hold a final close and an aggregate total equity raise exceeding full year 2024, which, I mean, you guys know, 2024 was the lowest annual total in a decade. So I'm going to kind of turn to you, Lauren, and then Brian. Do these sort of totals, as you see them, and the sort of the way it's come in, does this match with what you're seeing in the market, Lauren?
Yeah, absolutely. I mean, I think that we saw a number of fundraisers between 23 and 24 have to come back, ask for extensions on that fundraising. And I just think in 2025, we've seen our client activity pick up across the non-core space. So this is really right in line. It's interesting. I do see a little bit of a pattern of Q3 dipping a tiny bit. I think that also matches summer and board meeting schedules. And I all of this makes perfect sense that you see a slight slowdown in the third quarter. But I would guess you would see an uptick again in the fourth. But this is very much matching what we're seeing out of client interest and what we've seen in the universe in the fundraising pace. And, I'm sure some of those funds that closed in Q3 may have launched and done a 2-year full fundraise process.
I do have one question coming in from the audience real quick, and I will tell you multiple questions. This is global fundraising, not just US based, although as we get into it, I will say 80% of this was raised by funds focused on North America. So this is total fundraising globally, but there was a strong bias toward US activity. And I think that's kind of interesting because, in April, we saw the Trump administration introduce some sweeping tariffs that raised a lot of maybe questions and concerns for people about what that might mean. Do you think that had any impact on fundraising? We had that very strong Q1 and then things maybe slowed down a little. Brian, do you think there was any impact there?
Yeah, I mean, I would say maybe to a lesser extent, yes. But I think overall there wasn't too much of an impact. I think it does, and Lauren could probably answer this better than I could, but I think it definitely gives investors a chance to delay, right? Any opportunity for them to just take some more time and wait, as a capital raiser on the business development side, I'm not a big fan of that, of course, but I think from an investor standpoint, it gives them an excuse to push things a little bit further out. So we did see a little bit of that, I will say, with the opportunity to just pause, put things on hold, get a better sense of where things will shake out. I think for the most part, most people feel pretty good about where I think tariffs stand, although the obviously recent Supreme Court conversations could throw, a whole other kind of time bomb on that if things were to not be able to be used in the same way that he was thinking. But I think overall, I would say that we did some research on our end, and the real effect of certain costs was fairly minimal. In particular, we looked at multifamily and industrial. I think multifamily, through a group that we worked with, was somewhere in the range of 3 to 4% overall impact on costs, and then industrial, I think it was right around 2.75% impact on costs. So in the grand scheme of things, I don't think it made too much of an impact on the construction costs. And this was more focused on development on the construction cost side of things. And so from a fundamentals, not necessarily there, but again, I think it did give investors just another excuse to push things off and to hold until things, which they always, could use to push things off and, make sure decisions get a little bit kind of later into the year.
Lauren, does that sound, how's that sound to you?
I mean, I would reframe it as I think it gave investors another dimension in their diligence in
Fair.
terms of some questions. I think there was more attention to the potential for what that increasing, the potential increase in cost, what it actually was going to be, and then how that would affect, them as an LP. I don't know if I saw a push out of decision making, but certainly an extra sort of section in the diligence agenda around it.
Which is fair. This is absolutely what they should do, right? I'm not arguing with
You
that
know?
part of it as well.
Well,
Um,
I do recall back to sort of Q1, the feeling we had, maybe in January. I remember at our VIP Americas conference at the beginning of this year, there was this sort of feeling like the floodgates were prepared to open. 2024 was hard, but we stayed alive till 25. We were ready to go. And, a lot, like you mentioned, Lauren, a lot of that sort of 24 fundraising that had gotten pushed out, maybe those funds held their final closes in Q1. And, we were, and then, I think Liberation Day, everyone was like, well, maybe we take a moment.
yeah. Yes, that sounds very familiar. Yes, exactly.
I don't think there's a playbook on how to deal with capital pacing in the uncertain geopolitical environment. So I think, it's there's a big question mark over how to manage that for, I mean, really everyone.
Well, and that doesn't even take into account, sort of the other big story that we've been hearing, which was just sort of slow distributions,
Yeah.
not as
Mhm.
much capital to put out. I am gonna take a look at what proportion of that fundraising has been focused on real estate debt funds. We saw only two real estate debt funds holding a final close in the third quarter with an aggregate fundraise of 450 million. Very much a step back from earlier in the year. We saw 15 billion combined in the first half, um, focused just on real estate debt funds. We saw $20 billion raised during the entirety of 2024. What are your thoughts about real estate debt fundraising in the current environment? And maybe, I'll start with you, Brian. I know you said you look at both the equity and the debt space. Do you see sort of a shifting appeal there?
Yeah, it is interesting. When we were talking about this before, I kind of made the comment that I was not shocked to see kind of that lower level invested in fundraising, just being in the fundraising side right now with two debt funds in market. I will say, I do think actually there was an article that IRE.I that you all put out in September around this idea of define me and where does real estate debt sit, and that continues to be a hurdle, particularly for a lot of institutional LPs. Does it sit in private credit? Does it sit in real estate? Does it sit in fixed income? And I think a lot of groups, if it doesn't sit in any of those places, doesn't sit anywhere, right? And so no one's going to really take up that mantle and kind of get there. There obviously has been very successful closes and capital raising within debt over the last kind of year. We've seen some big investors come into this space. So interestingly enough, I think these numbers will increase going forward. You're seeing a lot of funds that have just been launched in the last 12 to 18 months. So I wouldn't be surprised if you see more funds close, in particular the way that these stats are reported going into 2026 because of some of the groups that have put a lot of investment into it. And so I do think you are seeing more and more groups recognize the opportunity there. But it is still a very hard place to get dollars allocated to. I think a lot of groups want to have conversations around it. They see the opportunity set. But are the dollars really following it in terms of action? That's, I think, a little still TBD. But I do, we obviously believe in it. We think it's a great asset class. We think it demands kind of a piece within the portfolio. Personally, I feel like you're going to see more private credit allocations within real estate debt. It just seems like that's where groups are tending to focus a little bit more, whether it be overweight traditional corporate lending or wanted to diversify through an asset-backed strategy. Real estate can kind of check that box for you. So we're seeing and hearing more of those conversations about really where will real estate debt go? Will it become more of a strategic allocation going forward? So my hope is you will see kind of this little blip here in Q3 bounce up in Q4 and continue to go that way into next year. but there are still some hurdles and challenges for the asset class as a whole.
Lauren, I want to pick up on something Brian mentioned about,
Mhm.
that investors may struggle with where to allocate real estate debt.
Mhm.
Does that vary amongst your clients? Are they, or do they have that same sort of, what are we going to do with it?
So I think we see it sit in a lot of different places in client portfolios. Yes, for sure, it's part of a broader real estate mandate, but for some groups it's in private credit and for some groups it's in fixed income. I mean, Brian kind of hit the nail on the head there. And sometimes when it's outside of that real estate portfolio, I don't always have a front row to the conversations around real estate debt because, maybe it's the fixed income team talking about it or the private credit team talking about it with their private credit specialist. So, sometimes it is a little bit of a black box for everyone.
And I think, the other part of that too, Laura, is it's somewhat of a different conversation. When you're talking to a private credit person versus a real estate person,
Mhm.
it's a different conversation, a different presentation, how you think about it
Mhm.
in terms of the real estate versus the debt. When you're talking about financing, you're talking about leverage, and you're talking about, and there's a number of components that I think is kind of interesting as it relates to messaging and where it sits. That I think is evolving, and to me, there is, I think, an exciting future for its potential. But I feel like, particularly from a private credit standpoint, we're somewhat still early days. There are some groups that have been doing it very successfully for a long time, but I think that's going to continue to grow.
And Brian, I think you made a really excellent point about having conversations. And I think that is, we weren't necessarily seeing this giant uptick in groups allocating to debt funds, but I do think we did see and have been seeing more requests and our own presentations around real estate debt. So, I mean, to your point, that trend would say there's still more to come. Although I do think in terms of the proliferation of debt funds that have come out in the last couple of years, I'm not totally certain if the number of funds out there matches the active interest. But again, there's just probably a little bit more to go on that runway.
And these totals right here, this is a closed-end fundraising only. I did have a question from the Q&A asking, maybe if you have any insight onto the open-end debt side. Do either of you have any idea of how that's looking right now from a fundraising perspective? I know, Lauren, you said that's not really your space, but any thoughts, Brian?
Yeah, happy to take that one. I would say so. We do have an open-end debt fund, so I'm fairly experienced in this. The short answer is it's not great. I'll be completely honest. I feel like open-end debt, has had its struggles. I will say that it's somewhat bifurcated. It's particularly for groups that have legacy exposure that were making loans, pre-COVID. Have some issues in terms of their portfolios. Groups that on the other side of that have a little more cleaner portfolios, maybe started within the last 3 to 4 years. You've seen actually be pretty successful. As I know publicly last year, there are a couple big searches that were awarded to open-ended debt funds. And so I do think that bifurcation is fairly strong. You are seeing a good amount of debt funds on the open-end side start to go into wind down mode from big names, and so I think there is, depending on what that portfolio looks like, could be some issues there, but I think overall it's still in that very similar, in my mind, broader real estate debt conversation that's the major struggle for it. You're probably going to see, my sense is, more closed-end debt funds be successful relative to open-end debt funds going forward. Now, I think the risk return profile can be a little bit different there. I think you can have more of that core plus value add type of debt, whereas similar to equity, you're going to have more of the core plus open-ended debt funds. But I do think there is obviously, a great potential for open-ended real estate debt going forward. It's how that portfolio is built and the types of loans that you're making. I think that's going to just be, that again, that split between essentially winners and losers within that space.
All right, I'm gonna jump ahead to our next slide. This takes a look at average fund size. And again, the Q1 big fundraising totals and a bunch of big funds. held, what we would call a mega fund, held their final closes in the first quarter. The last 2 quarters, we've definitely seen average fund size sort of drop back into that sub 1 billion space. In particular, just to provide a little color here, many, while the average was, just under 800 million, the median was below 500 million. We saw a lot of very small funds. And I think we identified two different reasons for that. In looking at the data. One was the number of, sort of early in the fund series. I think that was a question you had for me, Lauren.
Mhm.
I looked, of the 26 funds that held a final close, only 11 were the third or higher in their series. So, and 11 of the 26 were either a first fund, like specifically in their name, or just unnamed. So sometimes it's unclear with that. But that really is a lot of earlier funds, which is kind of, suggests that maybe first time funds are actually finding some traction. The other thing that we saw was that it was a lot of sector specific funds. So of this, 11 were residential, I believe. Let me make sure. And I think another 6 were industrial focused. So, all told, the sector specific funds, I don't think it's a surprise that they're smaller. I think that sort of tracks with just how the market works. With those sort of two pieces of information, though, I might kind of ask you, what are you seeing with regard to sector specific versus diversified? Lauren, do you see your clients looking more for these sort of specialized sector specific sharpshooter type funds, or do you see more interest in maybe a more diversified approach right now? Or does it vary, and why might it vary?
So I think it definitely varies. I think there's appetite for both, and it's going to depend on the client. I think that when you think about a smaller client that's going to make less fund commitments because of the size of their portfolio, those are groups that are going to want to be diversified, and they're going to want to let the manager make that choice, right? That's the expert that they're hiring to invest their money, and they're going to want a diversified portfolio based on what their managers are seeing as the best opportunities in the marketplace. I think there are still groups within that smaller client and segment that will really believe in, and I think residential and industrial are the property types that we've seen, maybe that smaller to medium sized investor want more exposure to. And then obviously some of the larger plans, they want to take those sector bets themselves and find those the sharpshooters with the excellent track records to give them more of the market segments that they like. I will say within the diversified appetite, and that applies to larger investors too. The large investors still want diversified funds. I think, and I'm sure this comes as no surprise, but that is diversified across the full opportunity set. So we're never talking about the 4 main property types anymore. When we say diversified, there's a lot of appetite still, I think, for those other alternative niche, whatever you want to call that, just the full spectrum of institutional real estate when we say diversified.
Anything to add on that, Brian?
No, I was just going to basically agree with Lauren, because I think the conversations that we've been having in particular have been, and I should say, preface that we do have a diversified strategy, particularly on the equity side. And I think it has been, kind of a combination of both larger groups and smaller groups. But there definitely is a focus more on, and just to kind of reiterate, I feel like most larger groups, they don't really need a diversified fund that's just going to be multifamily and industrial, right? They can get that in a number of different ways. I mean, to your point, Loretta, of the funds closed, 11 multifamilies and 6 industrials just closed. I mean, there are a number of different groups out there that can provide some real alpha and value, particularly in those spaces. But it is the other areas. It's still the other sectors that I think groups I think whether it be self-storage, whether it be senior housing, whether it be manufactured housing, whether it be, IOS, all these different types of areas that I think groups want investment in, or we at least want to kind of understand more about the opportunity set. You're typically getting that in a diversified strategy that might have exposure to multifamily industrial for sure. But if those are the only two sectors, there's probably going to be that's going to be a harder to come by type of exposure because of the opportunities that are out there. So I think there does seem to be somewhat of a I feel like kind of going into next year, having conversations with a number of LPs that might have done a lot of sector specific strategies, particularly over the last maybe few years, that now are maybe tilting back. So some of that, I would say that was middle types of groups, not necessarily the large sophisticated players because they have their allocation set. They continue to kind of roll that. But maybe groups that took their shot more on some of the sector specific strategies, that are now maybe tilting back towards diversified, thinking this might be a good opportunity to have a manager be able to look at the entire really set right now, given where we are with valuations, given where we are with kind of that focus on trying to get access and exposure to other areas. So we have seen those conversations pick up, I think, more than originally we expected, with groups thinking maybe now is a good time to be in diversified because we want to take advantage of a potentially strong vintage and we want somebody to be able to pick whatever risk-adjusted return opportunity is good out there or is best out there rather than just being a multi or just being industrial or just being in certain sectors. So that has been, I think, something that's been somewhat surprising, in a positive light, I think, for I should say biased, for groups that have diversified strategies. But I think the multifamily industrial and obviously all those sector strategies are always going to be a huge part, of everybody's portfolio, particularly the larger groups.
Well, and I think, there was definitely a moment, especially coming out of the pandemic, where, the number one predictor of your performance success as an LP was just how much you had in residential and
Yeah.
industrial.
Mhm.
And like if you overweighted to industrial, you outperformed. And that was sort of you didn't really have to be too choosy about who you picked
Correct.
or what their strategy was or anything. You were doing warehouses. And now it sounds like maybe we're shifting back to more, maybe it's less about the sector and more about the vintage. It's more about the team. And that does maybe prioritize more of at least giving diversified a second look. Does that match?
I mean, I think so. I would let Lauren. I do think there's another component too to exactly your point, letter of the tide's coming in a little bit also, right? So you kind of want to see who's wearing so clothes at that point, because I think there is gonna be going forward again this kind of split between winners and losers, and everyone was just to your point doing very well with rates where they are and doing multifamily and so it was pretty easy to be successful. And now, with particularly over the last since rates have come up, I think there is tending to be a winners and losers split and groups. This might be a segue to you, Lauren. I think as you're researching groups, and you're seeing that performance, I'd be curious to kind of hear how clients are thinking about that.
Yeah, and Loretta, I think when you were just listing team and those sort of different parts of what makes a real estate investment appealing or successful, I think it's becoming an asset. It's not the sector, it's the asset that groups are investing in. And I mean, Brian, you hit the nail on the head, and I feel like I've been a broken record in meetings with this, but you can see the divergence of performance of groups that were able to sort of ride real estate beta versus the groups that were able to pick the better assets. And that's, when I review a fund series, fund over fund over fund, and you see one vintage year, I'm looking at the whole track record, in 3 years later, right? So it looked great 3 years ago,
Yeah.
and now that might not even be true because we're in 2025, not 2024, or 2023. So it is very apparent, and it's just becoming more so as you look back at your last diligence memo for Fund 4, and now you're doing the Fund 5 memo and seeing where performance has settled in a 2017 vintage year fund or a 2018 vintage year fund. I think that makes the performance analysis that's going to be just a very key piece. And again, it's who can really pick that asset. And we're just seeing a lot of divergence.
I did get one question a little bit earlier. So, I did mention that in Q3, 80% of the capital was targeted toward North American real estate, which that I was asked if that compares to the average. That was actually a little bit of a departure. That was higher than usual. Looking at the 12-month totals, you can see while, North America, US, Canada is the largest group, it's not 80%. So I think it was a bit of a surprise actually for us to see that, especially coming on the heels of the second quarter when we saw 1/3 of capital raised for European real estate. So, obviously some of it comes into just you have these sort of lumpy things. So Q3 might have been just sort of a little bit of a fluke. That's why we look at the 12-month totals. One of the things I might ask you is, what kind of an appetite are you hearing for US versus international real estate? And does that appetite vary between US based, domestic LPs versus international LPs? And maybe I'll start with you, Lauren, on that.
Sure. And I will say that I am closest to domestic LPs, so I can give you the US perspective. And it's going to be a little bit of a similar story to sort of property sector allocations. I think you do see the larger sophisticated investors still trying to find the best opportunities, and they've got the time or the resources, the staff and resources to be able to find those groups in the regions that are kind of the best local players. But I mean, that is a lot more diligence for, especially if those investors only have US based teams, to get to know the European players and the Asian players and who's really good at what they do in the marketplace. I would say, again, some of the smaller, more medium-sized investors, if they want international exposure, and I don't think anybody, I think everybody acknowledges there are specific opportunities in the regions. There is some divergence in the way real estate performs and, the way Japanese office performs relative to New York City office, right? So if we're working with smaller, more medium-sized clients that want some of that exposure, it's likely going to be in the form of a global fund. Again, they want to let the manager that will have players on the ground in those spaces do that, pick their allocations rather than, deciding themselves. So I guess the global component of this chart doesn't surprise me, because I do think that's how a lot of our smaller clients are getting their international exposure.
Mm-hmm. Do you have any thoughts, Brian?
Yeah, I mean, I can just add, I think Lauren's gonna have a better perspective, obviously, working with, much more clients, but talking with, some of the LPs and trying to get a better understanding of, how they're thinking about allocation. And so, I guess on the first part of your question, in terms of, are they investing in other areas? Are they investing in Europe? Are they investing in Asia Pac? I think some of the conversations I've had recently, call it over the last 3 to 6 months, groups definitely are looking more at, I would say, Europe in particular, right? But I will say it's very similar to what we talked about with debt. They're having the conversations, but it doesn't really feel like they're actually putting dollars to work. And so now, is that because they're doing more research and they're finding that there's not as much of an attractive investment opportunity relative to the U.S.? Is that because for some other reason? That part I'm not sure on. But I do think, conversations are definitely being had on that end, given everything that's been going on in the U.S., particularly over the last 6 months, that it makes sense to look elsewhere. It just doesn't seem like there's real dollars going to those specific strategies, whether it be in Europe or in APAC. It's a different market in APAC and can be a little bit tougher to put those dollars to work, to Lauren's point. I think on the other side of it, we have had conversations with some of our European LPs, or APAC LPs, and I'll throw Canada in there as well, who definitely are questioning a little bit, does it make sense to invest in, the US right now? I will say, to Lauren's point, the bigger, more sophisticated investors, yes, they're not really wavering, I think. But what we've seen is some other investors, maybe groups like family offices, groups that can invest, I'll call it maybe a little bit on the personal or emotional side of things. There can be a relative value for them, where they might not. Groups that we talked to 9 months ago who were really excited, and 5 months ago are not as excited anymore, right? So I think that there is a component to that, particularly when it's talking about what type of investor it is, that might not be as excited. And we've heard this from Canadian LPs in particular. Um, Not super excited to invest in the US, kind of giving everything that's happening, but again, more on I'll call it an emotional decision as opposed to a fundamental decision. And so I'll be interested to see how that shapes going into next year in particular, when it comes to those types of investors and where they're investing.
Hmm. And I'm gonna jump ahead now and take a look at investment style. Now, I mean, obviously, and fairly obviously, I think to everyone in the audience, closed-end funds tend to focus on the higher return strategies. So, you see that in the emphasis on the value add and the opportunistic. What I think is interesting is that about, a year ago, we were seeing a pretty even split between value add and opportunistic, and we're definitely really seeing a sort of a strong bias toward opportunistic at this point. Um, any thoughts on that, Lauren?
I think that, and it's something that, we as a group believe in. I think the flexibility to work up and down a capital stack has shown to be a real opportunity, especially, when we're talking about the appetite for debt funds. Opportunistic funds tend to have that flexibility. And I just think the market environment of the last couple of years has sort of pushed that to let's give those dollars to groups that can take advantage of what side of the capital stack it has the most opportunity at this point in the investment period. So I think that makes a lot of sense to me. And I think that those are, again, those flexible strategies tend to be the higher returning opportunistic ones. So I will say that if we looked at this chart probably 5 years ago, I would guess value add was a lot higher, mostly because I think, towards going towards 2020, you saw the performance of the value add funds outperform opportunistic. So I think we are seeing that shift back towards the opportunity funds.
Yeah. And I just want to mention that, about 20 billion of this 21.8 was not disclosed. Many of those are, for instance, debt funds, or just other things. Coming back to Brian referencing the Define Me article that we published, sometimes these strategies don't always even really feel like a good fit for some of these debt products. Anything to add on the value add versus opportunistic split, Brian?
No, I was gonna joke that I promise I did not have Lauren set me up because we do have an opportunistic fund that goes up and down the capital stack. But I think the conversations that we've had around that have very much been to Lauren's exact point. I think people want that flexibility, the opportunity to do debt in certain instances, particularly higher up in the capital stack, like pref equity or maybe stretch senior, where you can take advantage of some kind of unique financing opportunities, or maybe it might be a mezz deal, whatever it might be. I think you're seeing a lot of those opportunities. I mean, we are just in our pipelines today. I know a lot of other groups are as well, that you can get paid, relatively high for the risk that you're taking at the moment. And so again, it doesn't surprise me that you're seeing much more of that opportunistic style and demand relative to value add. And I would also agree that the performance is a big part of that too, right? Value add has not performed very well, particularly, if you go back and you look at trailing periods relative to what opportunistic has. And then also I think that go anywhere approach as well. So the value add had been focused on primarily certain sectors, maybe it be multifamily, industrial, probably some office in there from a legacy standpoint, versus opportunistic, where you're going into different types of opportunities. And we're seeing that more and more in conversations I'm having with a lot of groups. They talk about their want and demand for what we talked about earlier, the niche sectors, some of these different opportunity sets that you necessarily can't get. And we haven't talked about the open-end space as well, but I know that's niche is not niche if everyone's doing it. So I think that is going to become a big part of the question. And obviously there was a premium that was being, a part of some of these sectors, whether it be self-storage, whether it be a student and senior, again, some of these kind of hallmarks of what the niche and alt sectors were. But if that becomes much more institutional, like we're seeing, what's next and how do you think about kind of going forward? And so I do think that I know that's probably teasing out a part of the conversation we'll talk about in a minute here, but another component to think of.
Well, and you bring up the core open-end fundraising side. Lauren, how does this compare to what you might be seeing on that side?
Uh, in terms of capital being placed,
Is there or is
the-
it, I mean, are we still deep in redemption land or
there are still some outstanding redemptions. I will say I think you see a much more active 2025 because some of that capital has come back and groups were waiting to free up some of that cash flow to kind of reallocate or just be able to put capital to work. So I do think this increase in activity, or I mean maybe correlating the increase in non-core fund final closes with sort of that timing, but it's not, we're not at the end of it yet. I know we're still waiting on few funds, but it definitely has freed up, and you can see it in the data.
right? Absolutely. And this is kind of being reflected too in the way valuations have shifted over the last, let's say, 12 months. All of that is coming in.
And I think also one component of that is groups had backed off their commitment sizes a little bit. I mean, we're still committing capital, right? That did not change. People stick to their strategic plans, they stick to their pacing plans, but that pacing was at smaller allocations. What I do also think is a direct result of some of those redemption queues being paid out is a return to normal in commitment sizes, which I think again we're seeing in those 2025 numbers compared to 2024.
Loretta, actually, another component I felt not only with liquidity, because that's obviously that's probably the biggest thing that people are talking about these days in terms of getting those dollars back and being able to work. I think what's interesting about this slide too is in some ways is a little bit telling on where we are in the cycle and how groups are thinking about what the best opportunity set is going forward. And I'll steal from kind of the PRIA conference, a couple weeks ago, in our Lauren and I's hometown in Boston, or Lauren's hometown. I'm just a visitor there most of the time, but I will say that one of the kind of more interesting presentations was a little bit about where we are in the cycle, and it's not, hey, I don't know if we're at the bottom. I'm not here at a market time and call, but we're somewhere near it, whether we're past it or whether there's still more to go, or at least somewhere in that vicinity. So I think at that point in the cycle, this is where you want to take advantage of potential opportunities where you can get those outsized returns, right? You want to buy low and sell high. I know most people don't do that, probably myself included, but I think there is just something to a little bit telling on, people are, I do believe it seems people are excited about the opportunity set and the vintage for real estate going forward, and how that pairs up to other private markets. I know that's another question we wanted to touch on, but this slide I think is somewhat telling to again kind of where we are and what people think about it in terms of the future.
And I'm going to move on to the next. So here's a number of key takeaways. Some of these I've already mentioned. I'm not going to go through these bullet by bullet, but I'll leave them up for a few minutes as we take some questions from the audience. I did have a few fairly specific ones come in. And I just kind of want to say I don't have those answers for you right now in the middle of a webinar. But if you get in touch with me or the IRE.IQ team, a lot of these can be answered using the data there. Getting questions about the fundraising by affordable housings in particular. Yes, that is a sector that we track. Yes, we can probably pull that number. No, I do not know what that number is right now. But I do encourage you to speak with some of my colleagues and maybe dig a little deeper into some of the more specific things that we can share with you. while we wait to see if any other questions might be coming in from the Q&A, one question I have for you, Lauren and Brian, do you think we're in the midst of a sentiment change, or does the mood today, Brian, you mentioned coming out of PREA a couple of weeks ago, does the mood now feel similar to how it felt 6 months ago, or does it feel different, Brian?
Yeah, I think it feels different. It does seem to be more positive. Funny enough, so I actually did listen to the webinar that you all did, towards the end of last year, so Q4, and everyone was really positive then too. So not a lot has changed. So to your point, to survive to 25, and here we are. So I'm mindful of that. We just feel like we're saying the same thing over and over, and it's this broken record. But I will say we are in a different spot, and things are different. Rates are obviously going the other direction in a positive way for us, with obviously rates coming down. And I think, and again, I know that most people aren't necessarily so focused on what the Fed funds rate is, but obviously, of course, where 10-year is, and we're seeing that isn't necessarily moving the same way. But I do think there is a positivity around just we feel like most of the questions and the uncertainty that were really the beginning of 25 and then kind of led through Liberation Day and other things like that is starting to, I guess, decrease in some ways. And you're getting a better sense of where things are. You're starting to see transactions happening more and more. I do think, obviously, there's a positivity. So it's more of a sentiment shift in terms of where rates are going. That's better. Does 25 basis points matter? No, to be candid. But I do think, groups are going to be allocating more. To Lauren's point, your dollars are coming back. You're starting to see dollars come back from not only closed-end funds, but open-end funds. And I think another area that I was talking to a fairly large LP, and they mentioned that, their pacing going up to 2020 or, through 2026 is going to be quite substantial, like much larger than it has been, where they haven't gotten a lot of dollars back. The valuations haven't been great in real estate, and then public equities have run up dramatically. So denominator effects actually now in our favor a little bit, which has always been the opposite. But or I feel like I'm always talking about it the opposite way. But those pacings and groups that were overweight real estate might go to underweight real estate. And so particularly for those groups that have those types of allocations, they're going to have to put dollars out, and if they want to get back to those target weights. So I do feel like just more generally, and coming out of here, there did seem to be a sense of positivity around just the space in general, some certainties that have been cleared up, and the opportunity to do more deals and get more dollars back. In particular, those two seem to be kind of the big major things where hasn't necessarily floodgates open, but it does seem to be some green shoots there where the idea being in 2026, more pacing comes out, more capital put to work, and then we kind of get into that, more positive type of view.
Yeah. Any thoughts on sentiment, Lauren?
I think I broadly, as a person sensitive to real assets allocations versus funding other private markets allocations, I would say through the first half of the year, maybe there was a little bit of pause, or I don't know if you call it breath holding around lots of new private credit allocations across public pension clients, infrastructure allocations. Where are those coming out of, or is that going to affect real estate allocations? And, of course, on the margin, they're somewhat, but I think it feels a little bit better now that we're in the fourth quarter that there wasn't a large effect on real estate allocations. There hasn't been a narrowing of those. So I think from that perspective, it does feel a little bit better. And I would say, anecdotally, if I sit on our alternatives review committee at Callan, so all of our private markets diligence goes through that committee. And the first half of the year was a lot of private credit with a lot of private equity, and maybe not so high on the anything real assets, maybe a little bit of infrastructure. And the number of real estate diligence projects going through third quarter and already to date, halfway through the fourth quarter is we've definitely seen it pick up. So it feels a little bit better.
That's a great bullet point right there. Yeah, we'll take
Yeah,
that.
yeah.
Um, I do have a question from the audience about the momentum in real estate secondaries. Do you see that continuing, and do you think these secondaries are cannibalizing other real estate equity allocations, or are they additive to overall real estate exposure? So maybe on the first question, do you see the momentum continuing?
Go ahead, Lauren.
Yeah, I think that there have been a solution to how do we continue to diversify a real estate portfolio for a number of groups. I think that sort of secondaries in their 2.0 existence that they're in now with, not just a buying an LP portfolio that they, for whatever reason, don't want anymore. Now that there's been the evolution and there are GP-led secondaries and, obviously some room for uh, saving capital structures and that part of secondary strategies. I think there will be continued interest and has been some interest. It's certainly not a strategy that we've seen every client have interest in, but I think it has a space in portfolios.
Mm-hmm.
I was just gonna add, no, I actually exactly what you said. I feel like it's somewhat client by client, or at least group that we talk to. There are some groups that just don't, maybe they're not sophisticated enough, maybe they don't have enough of a team or whatever it might be that have shied away from it for whatever reason. So there are groups that just haven't really invested in it, that maybe don't understand it, or I'm not really sure why, but I do think it makes a ton of sense when you obviously when you think about it. And of course, I think it's here to stay. I mean, you saw some really big funds get raised around it, so I don't think it's going anywhere anytime soon. I think those dollars got to get put out to work. And obviously more people are just going to follow along when they're seeing, the type of capital that is flowing to that piece of the market. But I do think it can serve a really good purpose for portfolios and being able to execute and get exposure to certain areas or certain discounts or certain prices. And so I do think it can serve as a really nice overall component within an allocation for sure.
I want to maybe ask each of you kind of what your outlook for next year is. Oh, I know. Sorry, Lauren. Sorry.
I forgot I was on camera for a second there.
No, I saw a reaction there. But just sort of, you don't have to give me. I'm not asking for specific numbers. Um, but and sorry to put you on the spot with an outlook that we're gonna check in with you in 6 months and tell you that you got it wrong.
That would be good. You should have us back and see exactly where we are with things. That would be pretty funny. Yeah.
What I would say is, what are you looking at right now to shape your sort of advice or perspective looking forward? Because of course, no, we don't know what's going to happen in 6 months, but what is currently shaping your current outlook? How's that for a question?
I can
Brian,
start.
you should probably answer.
Yeah, I can
Go ahead,
start.
Brian.
Sure. No, I think it somewhat encapsulates what we've been talking about. I think there is somebody's always told me they hate the phrase, but a cautious optimism kind of around, where we're going to go. And I do think, I will say, I kind of hammered this point before already, but the liquidity aspect and the transaction aspect, if those markets come back, that's the big thing I'm looking for, to be honest, Loretta, is can dollars be given back, and can groups begin to, in both, I would say, on the LP and GP side, get out of their own way a little bit and transact. That there has to be some component there to get things, just the ice to get broken, and for things to thaw and for those dollars to come back, because again, there's just an opportunity set here that we think going forward looks really attractive. But if people don't have the capital to put to work to it, then there's a chance that you might miss it. And so I do feel like if those two things and rates come down and sentiment particularly along other private markets, to Lauren's point as well, if people can kind of get on board, for example, foundations and endowments is always an interesting, in my mind, group to look at, right? Because they can invest across the whole private market space. They have been not necessarily huge real estate fans for the last however long, multiple years, because they can invest in private equity, they can invest in private credit, they can invest in venture, whatever it might be. I have found it interesting that we've had more and more positive conversations with those groups, thinking that this might be a good time to invest, whether that's a relative sense because other private markets, like something like private credit or private equity, have not done very well, which we're seeing they haven't. Then now might be a good time where groups haven't invested in real estate in a while, that they're going to start to allocate because they think it might be a good vintage. Because the groups that allocate to real estate always allocate. Now, whether they get the dollars back or not, that's the main issue. But it's the groups that don't, are they the ones that are looking at it? So I always think they serve as a nice bogey to kind of think about, excuse me, where the market might be going and if it's a positive potential opportunity set going forward.
All right, Lauren.
Do I get to say it's client by client, my consultant response? No, but I mean, I do think, look, we started the year with a lot of uncertainty in many ways in 2025. My outlook would be that, if we sit down this time next year, we will have seen everything feels better environment for 3/4 rather than that kind of seat of uncertainty. I mean, I'm not going to say, I feel like we've spent 2 years saying, or if not more, saying this is the bottom of the market.
Yeah.
I'm really hesitant to, even give a multi-quarter sort of cushion to the bottom. I feel like people that spend far more time in the minutia of the real estate market than I do have said, again, have made those calls for the last couple of years. But I'd like to think that there's less uncertainty around the markets and that liquidity is better. I think that just hopefully then translates to all positive things for our clients, for us and our roles. But I'd love to say I really feel like we'll be climbing out from the bottom next year, but I just don't.
Just say it, Lauren.
I can't. I don't have that confidence. Again, I've sat in so many research lunches or presentations at conferences over the last couple of years where it's like, this feels like it could be it.
It's fair. That is fair.
Do you think we're closer to the bottom than we are to the top?
Oh, yes.
Yeah.
That is
for sure. We can agree on that one. Yeah. All of us.
That feels good. That feels good.
Yeah, definitely.
Are we at the absolute bottom? Unclear. But we're certainly nowhere near the top.
Yeah, there it is.
Correct.
Do either of you have any just sort of a key takeaway on fundraising, Lauren, for the audience? Anything that we haven't covered yet, or maybe anything you kind of want to hammer home?
I was gonna say the one thing I'll be curious about it, and I'll tee it up maybe for the next two poor saps who are coming into these seats. But this idea of kind of where to invest and where to go next, we talked a little bit about it actually at a recent roundtable to think about what are the next sectors, right? If the niche sectors are becoming too mainstream, then where do you go from here? And there was discussions around aircraft hangars and experiential real estate and all these types of opportunity sets, and kind of really differentiated return streams and types of investor capital. And so I am kind of curious to see how that progresses as we kind of go more into where a lot of groups, of course, want to get exposure to these alt sectors. Everyone's kind of in the same boat. I get that. And so it's going to be interesting to see how it evolves and what people start investing in and thinking about. Obviously, I'm shocked that we're at 58 minutes in and we didn't mention data centers once. And so
I have a data center question that I keep waiting for a moment to move, and then I couldn't get to it. I think
easy segue. You're welcome.
We did the world a favor by not spending an hour on data centers, which is what I've done in every single call up to this point.
Yeah. So yeah, clearly that's obviously, that's something that everybody wants to talk about and is at the top of mind for a lot of investors. So thinking about, okay, where does that go and how does that evolve? And I know there are so many people out there on one side, there's so many people on the other. Is it the next life science? Is it, there's all these different types of kind of conversations that are happening. But thinking about all these other sectors and what happens and how that's evolved or how that evolves and really what is next, I think is going to be an interesting conversation over the next 12 to 18 months.
Yeah.
I
Final.
feel like you opened a Pandora's box of like the convergence of private markets asset classes. We've been touching on
Yes,
the
exactly.
real estate debt and private credit, and now you're saying
Yep.
data centers, and that gets into the, real
Infrastructure.
estate versus infrastructure. And I
Yep.
actually think I know the roundtable you're talking about. I think there's a lot of like those other asset classes, like where do they really sit in terms of real estate and infrastructure? But I don't know. Key takeaway, I think that I would just say that obviously investors are allocating, but they have a lot of choices. So I would just always, for the capital raisers out there, keep that in mind. Performance is going to be a key, I think, make or break for a lot of um, funds out there in the market, given the divergence that we've seen.
Perfect. Perfect place to end this. We're right at the end of the hour. I want to thank you all for joining us. I want to thank my panelists. I'd like to thank the IRE.IQ Data Services team, especially Nico Pepis, Director Karen Palma, the rest of my colleagues, Denise Moose, our special reports editor. Thank you all for helping me put this data together. Just a reminder, all of the data discussed in the program, it comes from our IRE.IQ database, which includes information on organizations, investment programs, and industry contacts, tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than 500 billion. Our next fundraising report review will cover fourth quarter fundraising and will take place in February. And again, thank you, everyone. Have a wonderful rest of your day.
Thank you all.
Thank you.